Hello and welcome to this episode here with me, your host, Dallin Hawes. This is the Hawes Federal Advisors podcast and YouTube channel. Welcome. It's always a pleasure. It is always great to be with you today, and especially today because you clicked on this video, which is talking about insurance, which, okay, let's just be honest here. It's not a sexy topic, but you clicked it. So congrats to you. Because I know whenever I produce stuff, I produce content all the time, I write articles, I do all this stuff for you as federal employees, okay? I know going into it that when I do stuff that's not about, let's say, the sexy stuff, like the TSP, your pension, those are kind of the sexier stuff. When I don't talk about that, I know it's not going to be as popular, okay? I know that going in. So thank you for clicking on this. Invest in yourself, because here's the deal. Insurance is a huge part of your retirement plan. Huge, okay? I'm not going to say it's more important than the TSP because they're both just very, very important. It's like me asking, hey, which of your kids is your favorite, right? They're all your favorite, right? Unless you actually do have a favorite, right? Then that's a different story. But when it comes to financial planning, and if you ask me, hey, what's your favorite topic within retirement planning? Well, they're both important. If you don't have one, whether it's tax planning or investment planning or insurance planning or whatever, if you ignore any one area, you're in trouble. You're in trouble. So thank you for being here. We're going to dig right in. So today is going to be a little different. I am going to dig into four, I put up three fingers, four different questions, the main big questions that I get on the four different types of insurance that you have through your job. I get these all the time. Now, I'm not going to go super deep, but the purpose of this video and this podcast is to give you a framework for all four of these insurances. And I've talked about these before, right? And if you're regular, you definitely heard about these things before. But my hope, this is the goal. Knowledge is great. Learning is great. But doing is where all the magic happens. You have to implement something that I talk about today in your life. You have to make a change. Or, best case, you listen to the whole thing and say, hey, actually, I think I'm good. I think I'm in a good spot. I've taken care of all these things before. Now that's you, awesome. But most likely, for most of us, there's going to be one of these coverages where you say, hey, I need to dig a little deeper. I need to make sure I'm covered and good to go. So that is the goal. By the end of this, I want you to come up with one thing that you need to do to look into, to come up with a plan for you now and then into retirement to make sure that you are good to go, prepared for all four of these, okay? Again, I'm not going to go super deep, but I'm going to give you an introduction to get you started thinking, okay? Perfect. So the first one. So I've got four questions, the basic questions I get all the time on these four different things, and we'll kind of go from there. So the first question, it's about your health insurance. This one's huge. Your health insurance is probably up there in the top one or two of your best benefits. So it's huge to keep into retirement. So the question I have is, hey, how do you make sure that you can keep your health insurance into retirement? This is huge. So there's two main requirements. The first, you got to retire with an immediate retirement, okay? So that basically means as a traditional FERS employees, not special provisions, you've got to have at least 5 years at age 62, at least 20 years at age 60, at least 30 years at your minimum retirement age. Or if you've got 10 years at your minimum retirement age, you can retire and you can keep your health insurance. Your pension's going to be reduced though. So there's going to be penalties and things like that, but you can keep your health insurance from there. So one thing you might have noticed as a traditional FERS, the earliest age that you can retire and keep your health insurance is your minimum retirement age, which for most of you is going to be between 56 and 57, okay? So what that means is some of you may actually be financially prepared to retire before that age. If you're a diligent saver and your salary is, decent, then you may be financially prepared before that age, but guess what? If you want your health insurance, which for many of you, most of you, is crucial into retirement, you gotta wait. You gotta wait till the minimum retirement age as the law stands today. Now, that being said, there's a couple exceptions. First, if you're special provisions, the rules are different, as you know. Second, if you get an early out, okay, the rules for an early out, to qualify for an early out, first, your agency has to offer it. They apply for it through OPM, and if OPM allows them to, they can offer it to their employees. And to be eligible for that, you have to have at least 25 years of service, and at any age, then you can take the early out. Or if you are at least 50 and have 20 years of service, you'd be eligible as well. Now, your agency would have to okay your application as well, but assuming all the boxes are checked, you could potentially retire early with that early out and keep your health insurance. So one thing, if that's something that you're interested in, get prepared financially. Make sure you have enough in savings and that your pension looks good. Make sure all those boxes are checked so that if they offer it, which you can't control if they do or not, but if they do, that you can be ready. That's huge, okay? So that's the first requirement. You gotta be retired with an immediate retirement or an early out to keep your health insurance into retirement. The second is you have to be enrolled in FEHB for the 5 years before you retire, okay? Now, there's a few kind of nuances. You can be covered under your spouse's plan. Let's say they're a federal employee as well. As long as you're covered under FEHB on someone's plan for those 5 years, you're good to go, whether it's your plan or your spouse's plan. Now, if you're under Tricare, my military vets, okay? If you want to keep your FEHB in retirement, your Tricare will actually count for this 5-year rule. So basically, let's say the 5 years before retirement, you're covered under Tricare. As long as you switch into FEHB for the last open season before you retire, as long as you're in FEHB when you retire, you can keep FEHB into retirement, okay? Now, you may ask, hey, what's the reason for doing that? Why would I want to do that? Well, FEHB is really, really nice to have in your back pocket. So one strategy that can make a lot of sense is you get into FEHB in the last however many months of your retirement. You get in the last open season, so you qualify to keep it into retirement. Once you retire, you still have Tricare. So you say, hey, I actually just want to keep my Tricare. Perfect. You can suspend your FEHB. And so basically what that does is it allows you to keep that in your back pocket of, hey, let's say the Tricare rules change. Maybe the cost goes up in the future. Maybe things change. You've got another option. And the FEHB, while potentially more expensive now, may not be forever. So you have it in the back pocket. You'd be able to suspend it, not pay the premium, but you'd be able to get back in later. And that, again, is just for the Tricare folks because the rules are a little different for you. So something to keep in mind. Next, we're going to jump on to the next insurance. So this is about FEGLI, or your life insurance through the government. I'm going to do a really, really quick overview. First, there's 4 different parts. There's basic, part A, part B, and part C. Okay, the basic, you automatically get enrolled when you're hired. So most of you will have that. That is the most cost-effective one. Your agency picks up a portion of the cost there. So it often makes sense to keep that for your entire career, just because at 65, assuming you pick the 75% reduction, you get free coverage for the rest of your life, right? There's some living benefits, there's lots of perks, as well as the cost is pretty consistent over the course of your career. So that one, if any of them, makes the most sense to keep for your whole career and then life after you retire. The Part B is the most common one that I get questions on, and that's the one where you can get multiples of your salary as coverage. Okay, that's your coverage amount. And the issue with Part B is once you hit your 40s, 50s, 60s, the cost just gets unbelievably expensive. It gets very expensive. So as early as, let's say, even your 30s, 40s, you want to start shopping around. You want to say, okay, is there better options? And now, if you're already in your 50s and 60s, it may be harder because your health may be not so good, but still, if life insurance is important to you, and I'm not saying it is, I'm saying make sure if you need coverage, get it somewhere, and if you're in Part B of FEGLI, make sure that you're getting the best price that you possibly can. Shop around, even if you're older, shop around. First decide, hey, how much coverage do I need and for how long? Then find the best place to get it, okay? So, I'm going to jump on to the next coverage here. Okay, so dental and vision. So this one is, of course, a little less common, but very, very crucial. So there's a huge perk, and I've got great news when it comes to dental and vision. And that is, you may not have it right now, or maybe you might. The perk is, even if you've never had it or during your career, once you retire, you can actually enroll or drop it. You could go back and forth in retirement. That's not a big deal. So let's say you don't know if you want it or you don't know if you want to keep it. No problem. You can get rid of it. You can pick it up again in retirement, no strings attached. The only rule that you have to keep in mind is you have to retire with an immediate retirement to qualify for that. And that's the same rules that I talked about before for your health insurance. Basically, age 62 in 5 years, age 60 and 20, your minimum retirement age in 30, or your minimum retirement age and 10 years, but you get the reduction to your pension. Okay, so those are the big rules that you have to know for your dental and vision. So again, you don't have to decide today whether to keep it or not. You can always jump in later or jump out later. Just know what options you have. Make a plan for you to see what makes sense, okay? Perfect. The last one is long-term care. And I just had a video not too long ago talking about that specifically. So if you want a little more meat, go to that one. I think it was a few weeks ago. But basically, here's the deal. You can get federal long-term care insurance through your job. The issue is with all long-term care insurance, it's expensive. And over time, there will be premium increases. It's going to increase over time. So if you're getting that, you want to make sure you can commit mentally to 30, 40 years of paying that premium. Okay? Because ideally, you're going to be retired for a long time before you need that, if ever, right? So if you want it, make sure you commit mentally to that long. Okay? Second, it's expensive. And especially if you're older, it's expensive. Okay? So I don't always have my clients get that insurance. It depends. But what I do require is we've got to have a plan. Even if it's not long-term care insurance, we've got to have a plan of what you're going to do if that need arises. Because not everyone is going to need long-term care, but if you do, you want to be prepared. You don't want to put your spouse or anyone else in a financial position or just a caregiving position that makes them very, very uncomfortable, or maybe they're not able to, right? That's a very, very tough spot to put your family members in. You want to have a plan. So maybe that's, hey, instead of buying the insurance, I'm going to earmark what I would pay in premiums, and I'm going to put that away in a savings account or invest it, whatever, so that if there comes a time when I do need it, the money's there. I got money, but I'm not putting money into a premium that I don't know if I'm going to ever use, right? That's one strategy. Another strategy is to kind of earmark maybe home equity. Maybe your home is paid off. You say, hey, I've got a few $100,000 here in my home equity that it's not really included in my retirement plan, but if I needed it at the end of life, I could always tap that, get money out, pay for my long-term care, and not harm the different parts of my financial plan. So those are some of the things I think about. But again, those are the 4 main types of insurance that you're going to have through your federal job, and it's your job to make sure that you're getting the most out of it, because getting the right coverage is crucial. Second, you can save hundreds, if not thousands of dollars by deciding, hey, I don't need X coverage, I don't need this coverage, where if you know exactly what you have and what you need, then the potential for savings and just being prepared for life is huge, 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 huge. So this is so crucial, and thank you for being here. Thank you to make it to the end. If you have any other questions, there is a link in the description below where you can submit questions, and I cover them every week on Saturday in my Q&A. I hope this was helpful. Have an incredible rest of your day, and please take action. Please take action. That's what actually makes a difference in your life, is doing something. So if you have to do anything with these 4 coverages, make sure you do it. Make sure you take action now, and I'll see you next time.